Let me just quickly introduce our panel and the context for this session. Exits have been a problem, a key bottleneck for funds, as we've seen from the first panel and from Jaideep's discussion. And to kind of discuss this, we have two secondaries specialists fund, Norbert Fernandez, who's the India head of TR Capital, and Jeremy Fu, the co-founder of Foundation P. Both of them will speak about how they're providing liquidity to GPs and helping LPs in, GP managed funds exit for the Indian environment. We also have Ishita Vora, who's the head of listings for NSE, and she'll talk about how the ecosystem of the startup ecosystem is shaping up and what kind of regulations are coming up, especially for, this will also help funds who are looking at exits from a startup perspective, companies that are looking at listings. Thank you, Ishta, for being here. If I can just start with the secondary specialists on, what are you hearing from the GPs on their lack of exits, and what are you hearing about fund extensions, and what are the concerns that you are hearing, and what kind of opportunities are you seeing in the market?
Sure, I can take that. So a little bit about us to begin with. TR Capital, we have been active in India, and we've been, I think, one of the early movers in the secondary market in India. Been here for 10 years plus. And having said that, I think activity has really picked up in the last 3 years. On the ground, what we're hearing, and you need to take a step back, and a lot of panelists earlier have spoken about the lack of exits for GPs and LPs. And that's something obviously which has been studied to quite an extent, and it's a fact that there's an amount of $150 or $200 billion that has been invested in the last 20 years, of which maybe 50% has been exited so far. And even within that, there's about 25-30 billion of invested capital, which is pre-2011, 2012, which potentially has an expiry date on it as we speak. So all of that gives you a sense of what is the pipeline for a potential secondary investor like Foundation Capital or TR Capital. But along with that, there is something which we believe is also a flaw in the structure of the way PVC funds operate in India, is the model of 7-8 year funds plus one, which has essentially been copy pasted from the developed world, and that is not generally a timeline in which sustainable businesses are built in India. And I think that learning has come over a period of time. So when you couple all these facts together, the way I see it is, just given the vintage of fundraising in India, the last 3 years we have seen a lot of situations where there is a need for liquidity for GPs, for LPs, sitting on perfectly good assets, sitting on perfectly good portfolios. Exit channels in India, M&A market, be it the listing exchanges, which Ishita will touch upon. These are all developing at a fast pace, and there are very positive signs there, but it's just not at the sheer quantum that is keeping up with the capital that has been invested. And there, so like she said, that's the problem, but for us it's the opportunity, and we only see it the pipeline getting more mature, and the sense of urgency getting a little bit higher in the last 3 years.
Okay, thank you. Jeremy, would you like to share some thoughts?
Sure. I would agree with Norbert. I think we definitely see the same kind of opportunity with a lot of GPs telling us that they are reaching the end of fund life, or their funds are already in their extension periods, and they have a whole lot of assets that they have yet to sell or have had trouble selling. I think a lot of GPs underestimate the amount of time required to run a successful sale process, especially if some of these companies have only recently started to become profitable. But aside from the lack of exits, we're also seeing a whole lot of opportunities for other reasons, like, for example, difficulty in fundraising in the primary market. A GP has also, might approach secondary funds as well, by seeding, a new fund with existing assets from some of their older portfolios. Or, a VC fund might want to, raise an extension vehicle so that they can continue investing in their portfolio companies to prevent dilutions as those companies grow and raise subsequent rounds. So the opportunities for secondary funds, I would say, are quite varied and very, quite fruitful these days.
Okay, thank you. Ishta, I want to bring you in here on the kind of ecosystem that you're helping develop from regulatory and from an investor perspective. What do your conversations look like with companies?
Well, I think to start with, I do wish that funds and especially PE VC funds speak to us as much about exits in their investee companies as they speak to us about our own exit, which is NSE's listing. But having said that, I think from our vantage point of view, which is as somebody who's like the traffic policeman who sees the flow of cars every day in the markets, what we do see is that the IPOs that have happened in India, particularly over the last 3 to 4 years, and very specifically from 2017 to 18, when the equity capital markets were all-time buoyant, have been at least 50 to 60% of those IPOs have been PE-led exits, right? Either the private equity-backed companies have raised funds, or they have been offered for sales by existing private equity investors. Now, if you look at this from a fund point of view, which is as GPs or as VCs or PEs, what we do see is that in the PE, the constitution of exits in the PE community, still south of 20% of that comes from IPO. And for VCs, that number is absolutely nil. VCs still don't use public markets as an exiting tool. So having said that, the other interesting point, I think, to what both Norbert and Jeremy were alluding to, we see that in India, the average age or the median age for companies to kind of come and hit the markets, public markets, is anywhere between 12 to 15 years, right? If you look at US or other contiguous markets with India, you would see that that number is between 3 to 5 years. So I think that speaks a lot. If you look at companies, some of the companies, unicorns or decacorns that we have in India, some of them have been there, and I mean, they're vintages of 2007-06. And if you speak to them, I think from the last maybe 7-8 years, we've only been hearing that next 2 years we are going to market, but it's not happened. So I think as a regulator, we have been thinking very progressively about how do we kind of create a more conducive public market ecosystem for startups, PE, VCs, and how do we kind of create this gateway and get these companies to market. And over the last few years, starting way back in 2013 and 12, what we did do was we allowed a carve-out within our mains, wherein new economy, loss-making companies could come and access the markets. It was a pretty landmark decision because in India, if you really look at it, the guardrails have been set so high that companies that were non-profitable pre-revenue, they had no markets. But in 2012, we made that change and we allowed these companies to come. We've seen about 18 to 20 companies. So everybody, companies from India Mart, Just Style, Matrimony, who've come and accessed the markets under that construct. The only pre-qualifier under that construct is that you need to pre-sell or you need to actually sell your IPO book to qualified institutional buyers. The other very interesting thing that the regulator has also done is that we have started a startup exchange. I'm sure, Jeremy, you would be able to chime in here on your example on managing exits on GNext. But what we've really done is we've kind of drawn a leaf from a lot of these startup exchanges globally, be it GNext, be it NASDAQ Private Markets, GEM, JASTAC, and we've kind of curated our own startup exchange, which allows high alpha, high beta, pre-revenue, pre-profitable companies to come and access public markets with only two qualifiers. One, they need to be institutionally backed. And second, they need to have at least 2 years since incorporation. and I think this is not just for PEs, this is for all VC-backed companies that can come and access the markets. And the last note is obviously the SME exchange, which I think, where I think I must mention that here because on the SME exchange we have about 200 companies, actually little northwards of 200 companies that have come and accessed. And very interestingly, we've seen Bloom Ventures, which has done a very remarkable exit on the platform, which is E2E, and they've created a post-listing IRR of about 50 to 60%. So I think the mechanisms and enablement tools have been there. What the big question to ask is, what are the funds thinking about getting these companies to the markets?
Thank you, Ishita. You know, one thing that you mentioned that I really liked was the exit timelines, the difference in the exit timelines in the US, which is, you know, where companies are prepared to exit in 3 to 4 years, whereas in India it's more 10 to 15 years sort of a timeline. Do you agree, agree? And that's an opportunity for funds like you, where you can come in and bring in excess liquidity into the market. I was wondering if you can talk a bit about the global investor sentiment in India. Globally, LPs are looking at direct and a co-investment strategy, whereas secondaries funds are slightly have a fund-of-fund construct. So how do you manage the economics?
So the one thing which I have come to conclusion on is that there's a lot of confusion about what a secondary fund does, and it's also sometimes confused with fund of funds. So I just want to put it out there that these two are quite different beasts in themselves, and each have a different value proposition, a different fee model, etc. So secondary funds do not necessarily sit as another layer of fees between an asset and an investor. What secondaries solve for is the fact exactly that. In most cases, a timeline mismatch, wherein a fund is reaching its end of life, but 2 or 3 of its assets have not really reached its full potential, and therefore would massively benefit from 2 to 3 years of extended runway. That's probably the most common use case for why a secondary would come in and solve a 3, maybe 4 year liquidity sort of structure that kind of addresses this specific issue. How are global LPs looking at this? I think in developed markets, the secondary asset class is much more understood and far more mature than it is in India. In India, even though we have been here for 10 years, we are only seeing it reach some sort of maturity and understanding in the last 3 years. And even then, I think there are just a handful of people who look at India seriously as secondary funds. And there's a fair element of educating the market involved, be it GPs, be it entrepreneurs, be it even intermediaries who work with these companies to raise funds. All that is, I think, moving in a very positive direction, but I think there is a realization amongst global LPs increasingly that this is a very unique opportunity in India right now, or maybe for the next 5 years, where there's a very heavy and very, very big pipeline of investments that are coming to the exit mode, where no natural exit path is visible, high quality companies, and they need maybe 3-4 years more to unlock that value. It's a fairly unique dynamic right now, which I think LPs are recognizing is an interesting asset value proposition in India right now. We are in the process of raising our 4th fund. Right. It's never easy, obviously, right, but it's our largest fund, and it's the value proposition when we communicate it has never been more well received than it has been today.
Wonderful. Yeah. Jeremy, your thoughts on this?
Sure. I think a lot of global LPs actually see secondary funds as a less risky way of entering a new market, actually. And that certainly applies for India as well. So, for example, a European or a US-based LP, they may typically enter a developing market through a fund of funds model. But a secondary fund is essentially a fund of funds model with seeded assets already. So we can show our LPs the portfolios that we are buying, the companies that the GPs that we are investing in have already bought. So you're not going into a blind pool fund of funds. Essentially, a secondary fund, you know what assets you're going to get. In terms of the second layer of fees, I agree. We have LPs, and we also end up being LPs to the GPs that we back. But clearly, it's not a 2 and 20 kind of economic model that we have. And also, when we restructure funds, we don't necessarily give the same 2% management fees to the GPs. I think a lot of it is a negotiation on what kind of budget he has to run, to exit the rest of the portfolio successfully. And then, ultimately we still underwrite our returns to a 25% net IRR to our LPs. So it takes into account, the risk-reward factor there. So I think it's all right.
You mentioned about it never being as easy as now, raising your fourth fund. Is it also because the slowdown and the listing options are fewer? So there is a need for GPs to look more towards secondaries specialists.
So the fundraise wasn't easy. Let's get that out of the way.
Yeah.
All I'm saying is that the reception and the ability to understand the value proposition of a secondary fund,
Right.
that has become easier to communicate.
Right.
LPs can clearly see the value and the need for this in today's market.
Right.
So yes, communicating it was easier, getting the point across was easier, but raising a fund, well,
Right. Always hard.
it's always tough.
I think
And it's
primary
always-
or secondary markets fundraising is never easy anywhere.
It's never easy. I think we can all agree on one point,
Right.
this entire room, is
Right.
that fundraising is not easy.
I can agree to that as well.
Right. What are the global lessons that you can bring to the Indian market? And there's somewhere, a place where I can bring Ishta in is also. What are the lessons that you're looking at from the global, market that you feel regulation-wise that we can bring to India?
Yeah. Like I mentioned earlier, I think we have really come a long way from 2011-12, and we have kind of created a lot of enabling frameworks. Very recently, something which I'm not sure how many of you here are aware about, but we've also allowed founders to issue differential voting rights shares, which essentially means that founders today can have superior voting rights and more control on their companies, and yet take them public. Now, fairly a lot of work, like I said, has already happened in this space, but from the global markets, what we do see is that there are several startup exchanges, and some of them, like ChiNext, have been pretty successful. Average market capitalization of a company listed on ChiNext is northwards of about $800 million. So that's, collective would be almost about $300 billion. Now that's a lot of capital, private capital or deep tech capital at the VC stage available for public market investors. In India's case, when we speak to CIOs as a regulator, what we do hear from them is a couple of things that have kind of been holding them back. For starters, I think they want to see value on the table. And I think, as we've seen in the case of US, where a lot of IPOs that have happened in the last 1 year, or especially the unicorns and decacorn IPOs, there's not been the private market, the valuations have been completely built in their private market rounds. So there's not much left on the table for the public market investors. So I think, one, they would definitely be looking at alpha on their investment, which I don't think there's much leg room left for that. Other than that, I think largely there needs to be a very established path to profitability. I'm sure a lot of us have been hearing about a mandate which has been going around on, there's been a lot of focus of late on ensuring that investee companies have clear per unit economics, and they have a very clear path to profitability before they can even think about accessing markets. And I think third, which I would urge a lot of you here to do, is that the Indian DFI ecosystem still doesn't understand a lot of these private market companies. It's pretty much of a chicken and egg situation. They can't come in when they are unlisted, and these companies never really come to the public markets. So I think a fair bit of education needs to happen from this room and from the ecosystem at large, engagement with these DFIs to kind of educate them on how these companies are built, valued, and how can they be looked at from an investment perspective.
Right. And if you can respond to that, she says Indian ecosystem is not yet, in terms of valuing companies, developed in terms of valuing companies. Do you see that as a challenge for your portfolio companies?
So I think there's a bit of a split in the market on that. There will be great examples of PE-backed companies in consumer financial services which are profitable and have generated exits for GPs. There's quite a track record of that already happening. I think the big part of the market and the big question mark is always around the tech kind of investments where for whatever reason they continue to be in investment mode and making losses, and what is the right time for them to approach capital markets. So for us also in our portfolio, there are a few companies which potentially will be going down that path and are just about breaking even. So there are two aspects to why something like this would be successful. One is willingness of regulators and exchanges to be innovative in the way they build platforms for such kind of companies. And secondly is probably more important, which is investor appetite and sentiment to actually subscribe to these instruments at the volume that the issues are built out for. So I've not found anything lacking on the regulators and the exchange's effort to innovate. But I've always had a question mark personally, and maybe a perception problem, whether the average Indian investor or the average even institutional investor in India is ready to buy into one of these tech unicorn kind of companies where a lot of investment is sitting right now and requires a very, very high scale of exit for it to be considered a successful investment. I've had that question mark on whether that investor sentiment is ready for that right now in India.
Right. Jeremy, are these concerns for you when you look at the Indian market?
Sure. I think for us, our experience is more concerned about private market valuations actually running ahead of public market valuations. So when we look at a portfolio that a GP presents to us as something they want restructured sometimes, I think sometimes the valuation expectations are quite inflated because they believe that a lot of these companies can list for extremely high multiples that we just don't feel comfortable underwriting to.
Right.
So I think for us, it's more a concern that private market valuations are overly inflated, actually.
Right. Is that specific to India or globally as well?
No, I think that's very common. We see that in China. We see that,
Right.
in any of these strong venture markets.
Right.
It's, I think initial rounds, seed stage, Series A stage, the valuations are extremely high. And whether or not you can sustain those kinds of valuations as growth slows, as a company goes towards the Series D and Series E rounds, that remains to be seen.
Right. Any lessons you would bring from, other markets to the Indian ecosystem?
I would say, overall that there still tends to be a bit of a stigma about GPs wanting to look for, GP-led restructuring solutions to their, to their portfolios. Right. I think globally, if you look at the volume of GP-led restructurings, it's become, very mainstream, a solution that a GP looks for, close to the end of its fund life. Right. I think the GP-led restructuring market has gone from about 10% of the overall secondary market to about 30% of the overall secondary market over the last few years. But I think as more and more blue chip, buyout and VC funds undertake these restructurings, I think the stigma, tend to dissipate, and GPs will see this as a viable option.
Norbert, do you share this concern that there is a stigma around?
Sure. So I largely echo what Jeremy is saying. The only thing I'll add is international, from what we have seen and observed, the model that seems to be most effective for any kind of fund restructuring or GP-led restructuring is one in which the timeline is reset for a fixed period of time, and the incentives and the upside sharing are very tightly defined to achievement of milestones, be it exits, follow-ons, whatever it is. Once those incentives and the model is defined very clearly upfront, that's when it tends to have a higher probability of success. And the restructurings that have led to good outcomes for all the stakeholders involved are the ones that were defined tightly. So if we see a situation where secondary has loosely just kind of rolled over the LP holdings and just given an extension for 3 years, that doesn't work. So my only pointer, or international experience which is relevant to GPs today is that that's the model which you should aim to work with, because that's what creates value.
We'll conclude this panel. May I invite all of you to give them a round of applause for a wonderful discussion. Thank you so much. Thank you to both.